Welcome to the deep dive. If there's one single thing that gives people instant financial cold sweats, it's the credit inquiry.
Oh, absolutely.
You know the drill, right? You're shopping for a car, you see a better credit card, or maybe you finally get serious about a mortgage, and then you hear that
I'm
phrase,
just going to pull your credit.
exactly, and you immediately brace for impact. You see
Yeah.
your score dropping in your head. The fear is real, but I think a lot of it is based on myth, not reality.
It really is.
So today, we are taking a whole stack of sources, FICO reports, consumer protection docs, some really deep financial analysis to just strip away the mystery. Our mission is pretty clear. We want to give you a really comprehensive but not overwhelming idea of what credit inquiries are, their actual weight, and most importantly, the specific rules that exist to protect you when you're just trying to be a smart consumer.
And that fear is so understandable. Credit scores feel like this mysterious, fragile number. But I think the most crucial thing we can do to, ease that anxiety is just clarify the two fundamental types of inquiries.
It's often hard.
Soft and hard. The moment you understand that difference, honestly, 90% of the mystery just dissolves.
Okay, so let's start right there. What is the dividing line?
The dividing line is really authorization and intent. A soft inquiry is almost always informational or promotional, and they will categorically not affect your FICO scores.
Not at all.
Not at all. Hard inquiries, on the other hand, they're tied to a specific application where you've authorized a creditor to pull your full report, to make a real decision. They may affect your score, but as we're going to see, it's usually by a really small margin.
And just to set the stage here, when we talk about a score drop, we're talking about the total FICO range, which is 300 to 850.
Right.
We have to keep that huge 550-point scale in mind when we talk about, a drop of a few points.
Exactly. Context is everything.
Okay, so let's step into what you call the safe zone, soft inquiries. What actually triggers a soft inquiry, and why can we just breathe easy when we see one?
You can breathe easy because a soft inquiry is basically a peek under the hood. It's not a full diagnostic test. It's used when there's no risk assessment needed for a new credit decision. The reason you can feel totally safe is, well, it's twofold. First, they don't count in the FICO calculation. And second, and this is maybe more important for your long-term plans,
Okay.
they are invisible to actual lenders.
Invisible. Really?
Invisible. A lender pulling your credit for a mortgage is not going to see your soft inquiries. They only see the formal applications, the hard pulls.
Wow, that is genuinely empowering to know. So give us the key examples. When am I triggering a soft inquiry and I might not even realize it?
The most common one and the most important is when you check your own score.
Right.
Whether you're using a paid service, a credit monitoring app, or, the free annual services, looking at your own report is always a soft pull. It's a vital self-audit tool, and you should never, ever fear using it.
Okay, so that's number one. What else?
Beyond that, you've got pre-approved offers. You know those envelopes that show up in the mail? You've been pre-selected for this amazing card.
The junk mail. Yeah.
That's a company doing a soft pull to target you, but since you didn't apply, it's completely harmless. They also happen when your existing creditors do routine reviews of your account to see if they want to maybe raise your limit.
I've also seen them pop up in contexts that aren't even about debt, like applying for a job.
That's a critical one. Soft pulls are very often used for background checks. So employment screening, insurance quotes, even tenant screening. For employers, they're usually just looking for major red flags, not judging your score.
So they're not trying to see if I can pay my bills.
No, not at all. They're checking for things like a history of massive default or maybe identity issues. Even the IRS uses soft pulls to verify your identity for, say, a tax refund.
So the takeaway for this first part is, if you didn't authorize a specific formal application for a loan or a credit card, you're almost certainly looking at a soft inquiry, and you can just disregard it from a score impact perspective.
Precisely. It's purely informational. Your ticket to constant vigilance without any penalty.
All right, let's cross the line into the risk zone, the hard inquiry. This is the moment of truth. You apply for a $50,000 car loan, you authorize the pull, and bam, you get the hit. We hear these scary stories, 50-point drops. How big is the hit, really, and how long does that impact last?
Okay, let's start with the most reassuring number we can. The official line from FICO, for the vast majority of people with a decent credit history, is that one additional credit inquiry will take less than 5 points off their score.
Less than 5 points. That feels more like a paper cut, not a gaping wound.
It should, but, and this is where our deep dive gets necessary, we have to talk about the caveats.
Of course.
That 5-point figure is an average. The impact is highly, highly profile dependent. If you have a long history of excellent credit, tons of accounts, you might not see any drop at all. But if you have a short credit history or very few accounts, the inquiry shows a higher need for credit, and that impact can be greater.
So those horror stories we hear, the 30-point, 50-point drops, I think our sources even noted outliers up to 74 points. Those are likely people with what they call thin files.
Almost certainly. It's either people with thin files or maybe they've already racked up multiple inquiries in a really short time. The model sees this sudden, urgent desire for credit against a very limited background, and that just signals risk.
It's the cumulative effect then, not one single event.
Exactly. Now, for duration, if I take that 5-point hit, how long is it actively hurting my score?
That's the key question.
The hard inquiry itself stays listed on your credit report for up to 2 full years, so lenders can see it for 24 months. But, and this is the critical part for your score, it only actively affects the FICO score for 1 year, 12 months.
Okay, so it's listed for 2 years, but it's only scored for 1. That's a really important nuance.
And we should add another layer here because our sources point this out. While FICO ignores it after a year, other models, like VantageScore, might consider it for the full 2 years it's listed.
Oh, okay.
But even with VantageScore, the impact diminishes so much after the first few months that it's pretty much negligible by the end. Still, it's a detail worth knowing if a lender uses a non-FICO model.
Let's talk about that underlying risk signal. You said more inquiries signals higher risk. Can you elaborate on that statistical link?
Sure. This is kind of where the scoring models justify their whole existence. Sources show that statistically, people who get 6 or more inquiries on their reports in a short time are up to 8 times more likely to declare bankruptcy than people with no inquiries.
8 times. That's a massive multiplier. But
let's pause on that. Is that correlation or is it causation? Does the inquiry cause the financial problem, or is it a symptom of a problem that's already there? That is exactly the right question to ask, and it's almost certainly the latter. It's correlation, not causation.
right.
A person doesn't lose 6 points and then decide to go bankrupt. A person who is already in financial distress is desperately applying for every card or loan they can find. That intense application frenzy is what the model flags. The inquiry is the warning light, not the fire itself.
Understanding that behavioral flag is a great transition to, I think, the next big problem every consumer faces, rate shopping.
Absolutely. The quintessential dilemma.
Yeah. If I'm buying a house, I need to compare rates from lender A, B, and C to save thousands, maybe tens of thousands of dollars. But if I do that, am I not signaling distress by getting 3 or 4 hard inquiries?
That's the fear. We're told to shop around, but we're afraid of penalizing ourselves for being financially responsible.
Yeah, what's the loophole? How do the scoring models protect us?
In the loophole, there is. It's called deduplication, and it's essential knowledge. FICO realized that if they penalized people for shopping for the best rate on major, necessary expenses, they'd be forcing them into bad financial decisions.
Okay, so what counts as a necessary major expense?
This protection applies specifically and primarily to mortgage, auto, and student loans. For these loans, FICO will group multiple hard inquiries that happen in a specific time frame into one single inquiry.
Wait, really? So I can shop 10 times, and it only counts as 1 pull?
That's the idea.
That's amazing. Okay, so let's get specific. What's the official timeline for that period?
This is the most critical detail for you to remember because the window varies a little depending on which version of the FICO score a lender is using. For the newest FICO scores, the shopping period is a generous 45-day span.
A month and a half. That's plenty of time.
It is. But because a lot of lenders, especially in the mortgage world, still use older scoring models, that window can tighten up. For those older versions, the shopping period is a much tighter 14-day span.
So actionable advice then. To be safe, no matter what model they use, we should treat the rate shopping window as a 14-day sprint.
That's it, exactly. If you're serious about a car or a mortgage, get all your formal applications in and compared within a focused 2-week window. That protects you no matter what. And this is knowledge that literally saves you money. A 0.25% difference on a mortgage is thousands of dollars.
And I read there's an extra buffer period, too.
Yes, the models are generous. For these specific loans, FICO scores also ignore any inquiries made in the 30 days prior to scoring. So that gives you an extra safety net before you even start shopping.
So if I get pre-approved for a mortgage on day 1, then apply to 10 banks between day 3 and day 14, I should only see the effect of 1 single inquiry.
That's the rule. You are rewarded for focused, responsible shopping.
Okay, where does this strategy fall apart? I assume I can't apply for 3 credit cards and 2 personal loans and have it all count as 1.
That is the line in the sand. Deduplication does not apply to multiple applications for credit cards or personal loans. The model views those products very differently. Applying for several credit cards quickly is seen as that exact risky behavior we talked about.
Desperate debt seeking.
Right, and those hard inquiries will remain separate and they will add up on your score. The model can tell the difference between shopping for an asset and just acquiring revolving debt.
This all brings us back to the question of weight. We've established the hit is small, it's temporary, but in the entire FICO score architecture, how much does this factor actually matter?
So little, truly. I mean, when we talk about building great credit, we're talking about building a massive, solid house.
Yeah.
The inquiries factor, which falls into the new credit category, that's the mailbox.
The mailbox, I like that.
It accounts for a minor 10% of the total FICO score calculation.
10%. So what are the pillars?
Hmm.
What's the foundation we should be focusing on instead of obsessing over that 10%?
We should be obsessing over the other 65%. The two major factors are payment history, paying every single bill on time. That's the biggest chunk, about 35% of your score.
Okay.
And the second most important is amounts owed, or what's called credit utilization, how much debt you have versus your available credit. That's another 30%.
So 65% of your score is just how well you manage the debt you already have. If you pay on time and keep your credit card balances low, say under 30%, that 10% inquiry category becomes almost irrelevant.
Precisely. It's the long-term consistent behavior that drives your financial health, not the occasional necessary inquiry. If your utilization is low and your payment history is perfect, you're extremely resilient to that tiny 5-point hit.
Okay, let's talk practical steps. How do we mitigate the impact, or better yet, just avoid unnecessary inquiries altogether?
The main strategy is what we just said. Stick to that focused 14-day window for major loans. But for things like credit cards where deduplication doesn't work, always seek pre-approvals first.
Ah.
A lot of banks will offer a pre-approval with only a soft pull. It gives you a strong idea if you'll qualify and at what rate, all before you trigger the hard inquiry for the final application.
That could save a lot of unnecessary hard checks. What about monitoring?
You have to monitor your reports regularly. You can do it for free. You're looking for unauthorized hard inquiries, which is a huge red flag for identity theft. If you find one, you dispute it immediately.
And can I remove a legitimate one if I just, regret applying?
No. If you authorize the hard pull, it has to stay on the report for the full 2 years. You can only remove it if it was an error or fraud.
One last detail. Asking for a credit limit increase. Hard or soft pull?
That is a classic trap because the answer is, it depends on the lender. Some will do it with a soft pull, just an internal review. Others will always insist on a full hard inquiry.
So what's the move?
Before you click that button, you call and ask the representative directly. Will this result in a hard pull or a soft pull? If it's a hard pull, then you have to weigh the benefit of the higher limit against that temporary 5-point hit.
That clarity is invaluable. Sorry, so to wrap this up, soft pulls are informational, they're safe. Hard pulls are generally small, 5 points on average, and their scoring effect only lasts for 1 year. And for the big purchases, that 14-day rate shopping window is your superpower.
And if there is one final piece of wisdom to take away from all this, it's don't let the fear of a temporary minor inquiry stop you from making a smart financial decision, like getting a much lower interest rate on a car or a home. That 5-point 1-year hit is nothing in the grand scheme.
And why is that?
Because while an inquiry affects your score for 1 year, the truly bad stuff, the really adverse events, they have much longer consequences. Certain public records, like a bankruptcy, can stay visible on your credit report for as long as 10 years. The short-term hit from seeking a better rate is nothing compared to the decade-long damage of poor payment history. Focus on the foundation of the house, not the mailbox.